Accounting is an important tool for businesses. It provides necessary information for making decisions, evaluating performance, ensuring compliance, and providing information to various stakeholders. We often hear the quote, "What gets measured gets managed." An increasing pressure to manage and reduce global greenhouse gas emissions has compelled companies to account for and report on the emissions attributable to their activities. Greenhouse gas accounting is becoming increasingly important, as companies look to meet the demands of investors and regulators for better measurement and better management of GHG emissions. In this segment, we will unpack GHG accounting and discover some of the prominent measuring standards that are being used around the world. Every organization bears a degree of responsibility for the release of greenhouse emissions into the atmosphere. Emissions within an organization's control vary by sector and business model, ranging from direct sources to indirect ones, through their suppliers, employees, clients, or end users. Measuring greenhouse gas emissions helps businesses understand their contribution to climate change, assess exposure to carbon taxes, and evaluate the impacts of potential carbon pricing mechanisms. Greenhouse gas accounting uses science to measure the GHG emissions associated with a person, organization, event, process, or product, also known as a carbon footprint. In a nutshell, it translates operational data, such as kilowatt-hours of electricity consumed for example, into a common metric for measuring emissions, CO2 equivalent. Different frameworks are available for greenhouse gas accounting and reporting. GHG Protocol is the most widely used GHG accounting framework for companies. The Partnership for Carbon Accounting Financials, or PCAF, is specifically created for accounting for emissions in financial portfolios. If you are engaging in conversations about carbon footprint or GHG accounting, it is important to understand the three scopes. Scopes detail where emissions come from. Scope 1 refers to the GHG emissions released directly from an activity that the company controls. These include emissions associated with industrial processes, where the business directly releases greenhouse gases. An example of a Scope 1 activity would be burning natural gas to heat a building. Scope 2 emissions are indirect GHG emissions released from the energy a business uses. For example, the purchased electricity. Scope 3 emissions are indirect GHG emissions that come from activities or assets that the company does not have direct control over. Scope 3 emissions may include business travel, purchased goods and services, waste generated in operations, emissions up and down their supply chain, etc. For the financial institutions, emissions generated by their portfolio holdings would fall under their Scope 3 emissions. Scope 3 emissions usually make up the largest part of an organization's GHG emissions. They are also the hardest to account for. There are multiple steps involved in measuring organizational GHG emissions. These steps include defining the scope of measurement, collecting the data, and converting it into CO2 equivalent, verifying to assure its quality, and reporting. Carbon emissions are usually calculated by an environmental specialist or by using carbon emissions calculators that are increasingly available and sophisticated. Some jurisdictions are making it mandatory to account and report on emissions information. As governments and large corporations around the world set greenhouse gas reduction targets, this puts pressure on their suppliers and clients to also measure and report their emissions, making GHG accounting increasingly important in the business world.